Hi, I'm Matt Simon. I'm here today with founder and CEO of the TABB Group, Larry TABB, and we're going to talk a little bit about banning exchange liquidity rebates. There's been some recent talk by the SEC and some of the things that have been going on with high-frequency trading that this is an accepted practice and that this is maybe the way that the market should go. Larry, what do you think about banning exchange liquidity rebates and what's this going to mean?
I think you're going to wind up having problems if you start, playing and dictating how exchanges should, price their trading strategies. Right now, rebates have enabled the exchanges to solicit significant liquidity from the high-frequency traders. It's very efficient. It's very effective. It is very high speed. It provides an incentive for traders to post liquidity, basically limit orders within each of the exchanges, and it incents them to provide very tight quotes within an exchange. So there are going to be two things that are going to wind up happening if you wind up banning rebates on exchanges. The first thing that's going to wind up happening is that if I no longer I'll move from a point in time where I get paid for providing liquidity to where you're going to charge me for providing liquidity. So taking liquidity and providing liquidity will wind up having the same fee. So if you're going to charge me for providing liquidity, what am I going to do? Well, I'm going to go provide liquidity in a place that won't charge me as much or won't charge me at all. And where are those places? Dark pools. So what's going to wind up happening is you're going to wind up seeing the liquidity migrate from the lit exchanges, where actually the SEC wants people to trade, to dark pools, and basically you'll wind up seeing a migration of order flow from the light to the dark. The second thing that will wind up happening is more and more liquidity either moves away from the market because my strategies no longer work, I'm not going to do this at all, or I'm going to go to the place where it's cheaper to trade, so I'm going to go trade in the dark instead of trade in an exchange. What winds up happening is in the exchanges, there are fewer people bidding for liquidity, and spreads will wind up widening. Mm-hmm. So, and when spreads widen, it becomes more expensive for retail investors as well as institutional investors to trade. So, with the whole idea of, okay, I'm going to ban liquidity rebates. We're going to get rid of these nasty liquidity providers who are, taking money out of investors' pockets. What you wind up actually doing is actually hurting market quality. The investors who are trying to buy larger blocks wind up being, paying more for that, and you wind up actually moving more liquidity away from the exchange than onto the exchange, which hurts price discovery and basically, reduces the quality market.
So you talk a little bit about the winners, you talk a little bit about the losers in this game in terms of if that was to happen or if this model actually happened. Do you have a suggestion for a better model that would help more market participants?
Well, right now, I think what you do is you let the markets evolve. Currently we're doing something, in between 8 and 12 billion shares a day. If you break that out by hour, a 6.5 hour trading day and 60 minutes in an hour, you're looking at something like 28 to 30 million shares are changing hands a second. And so you really don't want to change a structure that is moving that much very quickly and very radically. I think what you look at, try and do and get greater transparency on the markets as well as, dark markets and lit markets. And you get better understanding of market quality. What are the execution statistics within each of these pools? But to a certain extent, you leave them pretty much free to evolve and to cater to different market segments, and the folks that create a better mousetrap wind up doing better. And that's how capitalism really works. You create the best place, you wind up winning. And I think actually the equity markets are a tremendous reflection of that. We've gone from 2 exchanges that basically controlled everything to now more than 50 venues where you can trade equities, and you're seeing market share kind of split and become pretty much even across all the different venues. So it's a very interesting dynamic, and right now competition is actually very much in play in the equity markets.
Great. Well, I'm Matt Simon. Again, we thank Larry TABB, CEO and founder of the TABB Group. Catch you next time on the next version of TABB Group.